Hello everyone and welcome to this brand new video. One of the coaches at Unger Academy here, and today we're going to be talking about the foreign exchange risk. Now there are many traders who invest in foreign markets, that is to say in instruments that are listed in foreign currencies. And in most cases we're talking about people who trade on US securities and instruments, but don't live in the US. Now this entails making choices related to the management of the liquidity in foreign currencies. And since many of you have asked us what are the best choices to make, well, in this video, we'll try to give you an answer. And we'll do it by making the example of a European trader who wants to trade on US securities listed in US dollars. But before we begin, as always, I invite you to subscribe to our channel, click on the bell and leave us a like to this video. We would really appreciate that. Thank you so much. Hi, we are the Unger Academy, and we teach traders how to make money in the markets. Our founder, Andrea Unger, had been struggling with trading for years until he developed his automated trading method, which he used to become the only 4-time world trading champion. Subscribe to our channel for free tips and tricks. Okay, so regarding the topic of foreign exchange risk, we could consider a wide range of different scenarios for liquidity management. And in this video, we wanted to show you just 3 scenarios that we believe are the most common among investors. So the first scenario involves buying a security in a foreign currency without owning that currency. And this is the case, for example, of a purchase of Amazon shares using euros. The second scenario, on the other hand, involves buying dollars and then holding the necessary liquidity in the portfolio to buy foreign securities. The third and final scenario adds to point 2 a hedge using a future or other derivative instruments. I'd like to point out that for the cost analysis for each of these 3 approaches, we'll refer to the price list of one of the leading brokers available to us retail traders, and that's namely Interactive Brokers. So let's immediately take a look at the advantages and disadvantages of the first scenario. Well, assume that we have a portfolio totally in euros, and we want to go and buy an equity package or a dollar-listed asset allocation. The advantage of buying such products using euros is that in all respects, we won't be exposed to foreign exchange risk because we're going to buy products in foreign currencies. Our broker will allow us to buy such stocks by going into dollar debt, and so we'll end up with a long position on, for example, a stock and a debt of the corresponding counter value of what we bought in dollars for liquidity. The disadvantages of this scenario involve paying interest on the negative balance in foreign currency. Of course, any profit or loss received on the financial instrument listed in dollars will then be debited or credited in that currency to our account. So if we close a position in dollars at a profit, we'll receive a capital gain in dollars. Those dollars, of course, will be subject to exchange rate fluctuations. So while it is true that we have no exposure at the opening of the position, everything that happens after that inevitably leads us to be unbalanced on the exposure. For sake of clarity, let's assume that we buy 10 shares of Apple stock at $140 each. This way we'd end up with a debt of $1,400. So if the price of Apple rises, for example, to $280 per share, so it doubles, our dollar debt remains at $1,400, but the counter value of the position we opened is $2,800. And so the spread between these 2 positions will naturally be exposed to risk. Because if I close the transactions and sell the 10 shares at $280 per share, I'll end up with $2,800 minus the $1,400 of debt, totaling $1,400, which I've effectively earned, but is exposed to exchange rate risk. Now, everything works the same way with futures. The profit and loss will never be covered by the exchange rate risk, unless day after day we want to cover ourselves with derivatives, but I guarantee you that it's useless, and above all, a very expensive effort. So let's see how these things work in practice, so directly in the TWS. Now we're going to make a slightly more complicated example by adding a dollar part as well, but let's take a good look at what this is all about. So here you can see a demo account that has €500,000 and about $5,000. So let's try to buy a product listed in dollars. For example, we could take IDTL, which is an ETF listed in dollars that is widely used by Europeans. Suppose, for example, that we go and buy a quantity of 500, which corresponds, as you can see, to about $2,200. In this case, we're going to do a transmit, or rather override and transmit. Okay, this has been executed. So let's go take a look at the portfolio. You can see that our liquidity has gone down. The market value in dollars is $2,200. Our position has 500 stocks in this ETF. But what happens if we have to buy more? Or better yet, what happens if we didn't have these dollars? Suppose that we do buy more. So let's go and buy some more. So we'll go to order ticket and buy 1,500 more stocks. Let's use a market order. Okay, perfect. See, it'll be approximately $6,600. But we don't have that amount. We only have $2,500. So we'll transmit the order. And here our market value will be $8,890, and we'll have a debt of $4,088. Now, Interactive Brokers allows us to do this. So what are the costs of this $4,000 debt? So let's go look at it on Interactive Brokers. So we'll type in Interactive Brokers and go to the trading section. This is a margin, in this case a margin rate. Now, all the costs are, of course, annualized. So if it's a 2%, 3, 4, 5%, it means a 2%, 3%, 4%, 5% per year. And here you'll see, let's do the math. We already have the dollar currency set up, and we'll enter our $4,000. Calculate, and we're told 2.33%. This 2.33% is the price we have to pay to have a debt in this currency with this broker. But how is this calculation structured? So you see, the calculation goes in tiers. So let's go back and see what those tiers are. For debts under $100,000, there is a rate of 2.33%. For debts between $100,000 and $1 million, this rate will be applied, and so on. And the same is true for all other currencies. Let's move on to the second scenario, in which we decide to buy dollars in the cash market. So we'll have the dollars needed to purchase a foreign security. The advantages are that we own the liquidity and therefore have no cost. Why no cost? Well, because we don't have to borrow dollars. We don't have to borrow euros. So we'll never be in debt. However, the disadvantages are that we have total exposure to foreign exchange risk, because when we buy dollars, well, we'll be at the mercy of fluctuations of the euro-dollar exchange rate. The third and final scenario starts from scenario 2, but adds a partial or full hedge using derivatives. So in this case, we'll end up having liquidity in both dollars and euros, but we're going at the same time to buy a euro-dollar future. So with the dollars in hand, we're going to buy euros. In this way, we'll have a partial or full hedging, depending on how well we can hedge our quantity. For example, the main futures contract has a counter value of 125,000 euro. So if we went to buy dollars with a counter value of 125,000 euro and then went to buy a future, we'd end up with a full hedge. The disadvantages, of course, are the costs of this coverage. Now, what are the costs of futures? I'm not talking, of course, about the commission costs of buying the product or doing the rollover, although it should still be taken into account because it could be troublesome. I'm talking about futures costs that are related to the price of the futures. To analyze this properly, let's look at the futures prices quoted right now. So let's go to EURFX CME. And let's look at the quotes. For example, between June this year, 2022, and June next year, let's go to the quotes field and look for the last price. Now, if we wanted to buy a futures contract and hold it, let's say for 1 year, the price we'd pay is exactly the difference between this June 2022, and this June 2023. We're going to go do a quick calculation with the calculator. We'll divide 1.097 by 1.07105, and we'll get 1.025, which is a number that can be definitely compared to this 2.33%. Now, the purists, yes, will maybe kill me after what I said. However, this isn't about arbitrage here. 2.5 on one side and 2.33 on the other. Otherwise, we'd do it right away. What I did was just looking at the last price of a contract expiring in June 2023. That's obviously an entirely illiquid contract with an empty book. However, it helps us to understand that the annual percentages of taking on debt or hedging with futures are almost identical. Then there's the last cost, namely the costs that I called currency deposit costs. In other words, the negative interest that our broker will charge us if we go and deposit cash, in this case euros. We said at the beginning of this video, on our account. Holding money in the IB account has a cost that depends on the currency that we've deposited. So let's go again to the Interactive Brokers website and see what this is all about. In this case, we're going to be talking about pricing interest rates. And in case we've deposited, let's say, 100,000 euro in our account, we need to choose the reference currency in euros. So here it is. And you can see that we aren't charged anything for amounts under $50,000. But a negative interest rate of almost 1% is applied for amounts of $50,000 and up. So if we had 100,000 euro deposited in the account, we'd be charged 0.85% per year for only 50,000 euro. Now, the more observant of you may have noticed that I added these deposit costs only to scenario 3 and scenario 1. So scenarios in which there is still a balance in euros. So in scenario 1, we always had euros. In scenario 3, we also bought dollars, but we hedged with the futures. So we were left with a hybrid condition with both dollar cash and euro cash. In this situation, we had assumed that we were only buying dollars, so we only had a dollar account. And I didn't mark this cost because if we go and look at the pricing for Interactive Brokers for dollar deposits, a positive interest rate is applied, so no longer negative. Namely, positive 0.33% per year will be credited for dollar deposits. Of course, we are aware of the situation now with inflation at 6 to 7%, and so of course in this case it would still be reflected in a loss to have dollars deposited on Interactive Brokers. However, I didn't add it as a cost item because, as you see, interest rates are positive, unlike other currencies like the euro. So while this does conclude the overview of the main scenarios we may encounter in managing liquidity in our trading account, of course, there are many other facets and variables to consider. I personally keep most of my liquidity in euros in my account, and only a small percentage of dollars not hedged against foreign exchange risk, which acts as a bit of a buffer for possible strategy losses. It's an optimal solution for me, but it may not be so for someone else who perhaps uses the account for a different trade, or who prefers to be exposed to exchange rate risk. Well, we really hope that you found this video useful, and if you did, please share it and leave us a like. We would really appreciate it. And if you need help to start investing in the markets systematically, I'd recommend that you go and click on the link in the description below. It'll take you to a page where you'll find many useful resources, including being able to register for a free presentation by Andrea Unger. Or go and get our best-selling book, The Unger Method, covering only the shipping costs, or even book a call with a member of our team to get some free strategic advice. And lastly, I remind you to please subscribe to our channel so that you can stay updated on the release of any and all of our new videos and our new free content. And with that, we'll see you soon with a new video. Until then, bye-bye.